Right now, as this video plays, three critical numbers are sending shockwaves through the global financial system. Numbers the major banks would prefer you never see. $24 billion, 30%, and $8 to $10 per ounce. Together, these figures have ignited what I'm calling the Silver Betrayal. By the time most investors wake up to what's really happening, the opportunity to position themselves properly may already be gone. Today, I'm going to walk you through the evidence step by step, connecting UBS's massive capital crisis, China's sudden export restrictions, and the dramatic margin hike that sent the silver paper market into chaos. This isn't simply about fluctuating prices. It is about something far bigger, whether the entire paper-based silver market can even continue to function in its current form. Let's start with the most urgent point. The silver price flashing on your trading app or financial website is becoming less and less meaningful. Reliable data from bullion dealers who monitor the Shanghai Gold Exchange shows that physical silver is currently trading at a premium of 8 to 10 per ounce over the New York paper price. So when COMEX quotes silver at around $75 an ounce, serious buyers in China are actually shelling out $83 to $85 to get real deliverable metal into their vaults. This gap isn't some minor pricing quirk. It is the physical market shouting that the paper market no longer reflects true supply and demand. December 26, 2024 looked like an ordinary post-Christmas trading day on the surface. But beneath the calm, several massive forces collided at once. While most Americans were still recovering from holiday festivities, the CME group suddenly increased margin requirements on silver futures by roughly 30%. That meant traders had to immediately pony up an extra $7,500 per contract, or face forced liquidation. Silver prices on paper plunged more than $10 in a matter of minutes. Yet here's the key detail most people missed. Even as the paper price cratered, physical premiums in Asia actually rose further. Chinese buyers saw the crash not as a warning to step back, but as a signal to rush in and secure more real metal. In response, Shanghai warehouse inventories were drained at a staggering 56% rate over the following 90 days. Now, let's tie this together. UBS, one of the biggest players in the London Bullion Market Association, which sets global benchmark prices for silver, is under intense pressure from Swiss regulators. According to the bank's June 2025 filings, authorities are demanding an additional $24 billion in capital reserves. Imagine being a major institution with large short positions in precious metals derivatives. Suddenly, you need to free up tens of billions in capital, while at the same time, the CME makes holding silver futures dramatically more expensive. The result? A forced rush to cover those shorts, exactly when physical silver is disappearing from the market at unprecedented speed. Here's another red flag that rarely gets discussed. In healthy markets, silver lease rates, the cost to borrow physical metal, hover around a tiny 0.3% annually, essentially free. But late December data from trusted bullion dealers showed lease rates spiking toward 40%. Banks Don and T agree to pay 40% annual interest unless the alternative, defaulting on delivery promises, is even worse. These aren't ordinary borrowing costs. They're emergency flares from institutions caught on the wrong side of a genuine physical shortage. The plot thickens dramatically with China. Bloomberg reported that Chinese silver exports surged to a record 660 tons in October 2024 as exporters raced to ship before new rules kicked in. Then, effective January 1st, 2026, Beijing introduced a strict 2-year special licensing regime. Exporters must now prove annual production over 80 tons, show consistent export history, and maintain $30 million credit lines. In effect, China has taken control of 60-70% of the world's tradable refined silver supply. At the same time, Shanghai Futures Exchange warehouse stocks plummeted from over 100 tons to roughly 620 tons in under 3 months, a 480-ton drop. That pace far exceeds normal industrial consumption. What we're re-witnessing is widespread panic conversion from paper claims to physical metal because trust in the paper market, S ability to deliver, is collapsing. This isn't just a trader's problem. It directly affects you. The Silver Institute reports that industrial uses account for about 60% of global silver demand. Solar panels, electronics, EVs, medical devices, and more. When China restricts exports, cutting global tradable supply by 7 to 10%, manufacturers worldwide, including in the US, end up fighting over less metal. Those higher input costs get passed straight to consumers in the form of more expensive solar systems, gadgets, vehicles, and everyday tech. Silver shortages fuel inflation in tangible, visible ways. And for retirement accounts, many target date funds and institutional portfolios have reduced commodity exposure, relying on models that assume paper futures prices accurately track physical reality. But if paper and physical have diverged this severely, those models are dangerously wrong, potentially leaving millions exposed to hidden losses. None of this is new or conspiratorial. Between 2008 and 2016, 8 major banks paid over $1.3 billion in fines for precious metals manipulation, according to the CFTC and Department of Justice records. JP Morgan alone settled for $920 million over systematic spoofing, placing massive fake sell orders to drive prices down, then canceling them and buying cheap. These were criminal schemes, not isolated mistakes. The question is, did the incentives really disappear after the fines, or did the banks simply get more sophisticated at hiding the same behavior? The London bullion market operates mostly on an unallocated basis, meaning you hold fractional claims on a pool of metal that may not fully exist. Analysts estimate leverage ratios between paper claims and actual deliverable silver at 300 to 1 or higher. The whole system relies on the assumption that almost no one will demand physical delivery at the same time. But when physical premiums hit $8, $10 in Shanghai, normal arbitrage should flood metal from New York to Asia for profit. That isn't happening. Either logistics are broken, restrictions block it, or COMEX simply can't deliver without risking total breakdown. COMEX registered inventories sit at roughly 210 million ounces, while CFTC data shows commercial banks collectively short approximately 212 million ounces, basically the entire available stock. One serious delivery request could empty the system overnight. Add in 14 straight days of outflows, over 33 million ounces removed. Record retail premiums on American Silver Eagles, 25-35% above spot. And mysterious large options bets on junior silver miners placed minutes before close on December 27th, expiring mid-January 2026. These weren't random trades. They were informed positioning for violent upside. Past margin hikes, 1980, Hunt Brothers, 2011 spike, crushed leveraged speculators. But today's shortage is structural and industrial, driven by real consumption in China, not speculation. You can't stop solar factories or EV makers from needing silver with exchange rules. When the next leg up begins, there will be no weak hands to shake out, only desperate industrial buyers and trapped banks. That's when the move becomes explosive. Global demand reached 1.24 billion ounces in 2024 against supply of 1.01 billion, a 230 million ounce deficit for the 5th straight year. China's restrictions remove another 150-200 million ounces annually from Western access. That pushes the effective shortfall toward 400 million ounces per year. With total exchange inventories, COMEX Plus estimated LBMA, around 600 million ounces. Depletion could happen in under 18 months, likely much faster as panic accelerates. Physical prices in Asia are already 30-40% higher than paper quotes. The floor sits near $70-$75 because that's what real buyers will pay. Forced short covering could drive prices to $100, $120, then 150 pesos by mid-2026 as deficits overwhelm the system. For investors, paper silver, ETFs, unallocated accounts, carries growing counterparty risk. Physical metal doesn't. Businesses in affected sectors should lock in supply and hedge now. Consumers eyeing solar or big electronics purchases may want to move sooner. Prices are likely heading much higher. This isn't about chasing quick riches. It ends us as about recognizing a profound fracture in how global commodity markets operate, where decades of financialization and paper dominance are colliding head-on with physical scarcity and unstoppable industrial demand. The math is clear. The inventories are shrinking. The premiums are screaming the truth. The Silver Betrayal is the moment when paper promises finally meet physical reality, and the consequences are unfolding right now. The timeline is accelerating. The choice is yours. Adapt early or risk being caught off guard when the repricing hits full force. Thanks for watching. Stay aware, and I'll see you in the next update.